Hello and welcome to another Smaulgld podcast. Today is August 12th, 2019, and tonight's topic is where do you put your money when the bank charges you interest? Now, the following is not going to be investment advice, but we're going to take a look at this, I would say, very disturbing trend towards negative interest rates. Now, negative interest rates really are an anomaly. They're at the point now where a bond that you purchase will have the net effect of you paying the issuer to hold your money. Now, you would say only in an extreme case would you do that, because normally when you give someone money, you loan someone money for the risk of you lending it to them and the risk that you might not get it back, you're supposed to be paid for that risk, and that risk is paid in the form of interest. The idea is not that you give money to an entity and maybe you get some of it back and you're happy to get it. Well, that's what the market is doing now, is driving a lot of bond yields negative. There's been a lot in the news on this, and we're going to talk about what happens when yields go negative. What are the obvious consequences? What are the negative unintended consequences? But people have been following this for a while, and we've seen the Dutch yield curve has gone negative, and that's a major country. We've seen the German yield curve, the bonds of the Swiss yield curve, all going negative. And some are wondering even if the U.S. Treasuries would go negative. Here's a chart here by Holger Bits. I think that's right. And you can see the German yield is negative. So essentially, when you buy a German Bund, you're not going to get your money back over the period of time. You're actually going to owe a bit of money. And you can see the U.S. are not at historic lows, but I think that's the 10-year bond is looking like it is under 2%. So you still get a rate of interest on the U.S. bonds. But we are seeing an increasing amount of negative yielding debt. And here's one. This is a chart that Holger put together back in June showing the total volume of negative yielding debt at that time was $11.78 trillion. And I saw a chart yesterday. That debt, total negative yielding debt, is now at, looks like 15.2 trillion as of a couple of days ago. Now, those are institutional investors who are buying bonds, and that's what they're willing to pay. But it looks like now that this is creeping into deposits. Now, I would say regular bank deposits. That bank deposit's already negative yielding, and I'll tell you why. You don't get any interest on a standard checking or savings account at a money center bank like Bank of America or Chase. And in many instances, you pay about $150, $200 a year just to have the account. Well, that's in a sense a negative yield. You are actually paying the bank to hold your money. You don't get it back. It's not like at least you get the $150, $200 a year back in interest, because they don't pay interest. So you essentially have to pay. Now, there's ways of avoiding the $150, $200 fee. If you use your debit card a certain amount, they'll waive the fee. But the point is, if you just open up an account, it's going to cost you. So I would say that is a negative rate. But here we have USBS, Union Bank of Switzerland, UBS, not USBS, plans to charge rich clients for holding more than, I don't know, they come up with this number, $560,000 in cash as negative rates crunch profits. So the banks are realizing now that they're going to have to start charging clients to park cash. Now, central bankers somewhat like the idea of negative rates because they're always looking for inflation, and they figure that if rates go negative, people are going not to park their cash, because an economy does go well or does get stimulated when people spend money. However, the standard or the more sane way of spending money is that money comes from savings, not from whatever money flows through your hands actually just flows to your hands. It doesn't go to savings. It just gets spent immediately. The bankers tend to like that format. That's a Keynesian view, that's how you stimulate growth, is by spending, not by saving and spending, because that slows things down. So if you're going to get charged a rate of interest to have money in the bank, well, what are you going to do? Now, this is not the investment advice part, but if you are a standard investor and you can get a return on your money, I mean, that's the purpose of investing, not so that you can pay money. It's kind of more than cart before the horse. That's something like ass backwards. What can you do? Well, you're probably better off just holding cash somewhere. Now, the problem with holding cash in large amounts, like $560,000, if you're lucky enough to have that money, you really can't keep that at home. You can have a fire, you can get stolen, you could lose, I don't know. There's an insurance issue there. So you can say, okay, well, $560,000 UBS, I want to keep it there. Yeah, I'll pay you some money to keep it there. Not the smartest thing in the world, but it's still better than taking $560,000 in cash and taking your chances with it. Now, in lesser amounts, it does make sense. I mean, you can keep $100, $200, $300, $500 in your wallet or at home. It's not that big of a deal. It's better than losing $5, $10 a month on it at the bank. Now, the other thing one can do is one can buy gold and silver. You say, oh, you're just saying that because you have a gold and silver channel. No, one of the cuts against gold and silver has been that gold does not pay a yield. They always criticize it, and they say you have storage costs, insurance costs. Well, now those are no longer outstanding negatives against gold. They apply also now to cash if you're going to have to put your cash in the bank and pay to store it there. And also in amounts over, I think in the U.S., over it's $100,000 or $200,000, you don't get the insurance on it either. So gold starts to look on a apples to apples basis much more attractive. Why? Well, cash is cash. We know that. Dollars are dollars. Swiss francs are Swiss francs, and gold is gold. And we do know that there's less gold than there are Swiss francs, dollars, and other currencies. And we do know over time that fiat currencies have always lost and continue to lose, at least against gold. So if you're not going to get paid a rate of interest, and you can choose gold, or you could choose a fiat currency and pay money to have it stored, well, you might as well pay to have gold stored, because over time the gold is going to do better. Now, the gold storage rates might be a little higher, but the return also, at least in the last couple of years, has certainly been higher than just holding on to fiat currencies. And that brings us to silver. Now, you know, if you listen to this channel for years, I've been saying that silver does not have the same monetary allure, monetary demand that gold does. However, when you reach these negative interest rates and you're in a negative interest rate environment, I believe that silver will start to regain that monetary component that it has. Why? Because it is similar to gold, not in that it's the same color, that it has the same properties, but in that it is a precious metal. It is limited in, it's relatively rare. And it has served as a monetary metal in the past. So there's no reason why, given these circumstances, why silver can't regain some of its monetary mantle. Now, I was saying it probably would never become a currency again, meaning people probably won't use it, but that's the same with gold. People probably are not going to use gold again to transact. And you could say, well, if you digitize it and gold money and that, the problem with that is you still have, as we mentioned the other day when we talked about whether silver is a medium of exchange or a store of value. It's very hard, even if you digitize silver and gold, to spend it. I mean, it's easy to spend it, but it's impractical because every time you spend it, it is in effect, at least in the United States, a sale, which means you have to pay capital gains, which is not the end of the world, but you have to keep track of it. And if you have to keep track every time you spend it, it just becomes less attractive as a currency. Because remember, a currency, in order for it to be a useful currency, really has to be a frictionless transaction. If you got to write down or stop or create software to track your gold sales or silver sales that are done digitally, it's a nuisance. Similarly, if you had coins in your pocket and you were able to spend them, which you can't, but if you were able, it would still be inconvenient because not only would you have to carry them around, you'd have to get change, but then you'd also have to keep track of your sales. And again, that's a nuisance. But as a store of value, gold and silver do now make sense because they are easily liquid and convertible into the fiat currencies that you can use to spend. So rather than spending $8, $4, whatever they spend at Starbucks for coffee, in gold or silver, you can essentially sell larger chunks of your gold and silver, pay your capital gains. Now you've got your fiat currency, but you've held that gold and silver for a period of time where you're storing the value, and I would imagine the value is going up versus fiat currencies. And I would say, again, not investment advice, but if you have negative rates and you have money printing, it somewhat follows. It's going to be hard for the fiat currencies to maintain their value against stable commodities like gold and silver. Now, we've noted that silver has not held up well against fiat currencies. Gold has beat almost all fiat currencies, including the dollar, the past 50 years. Silver really has not beaten all currencies and has done 50-50 versus even the US dollar in any given year. I believe that's about to change if we continue to have this negative interest rate environment. Similarly, besides cash under the mattress, gold and silver, people can buy cryptocurrencies. Now, Bitcoin and Litecoin have not been around long enough. People are insisting they're a store of value. They don't know that. They've only been around 10 years. They may be. They do have the characteristics of being limited in issuance, and there's not that many of them. But then again, they have the same issues with using them as a currency. You got to keep track of each transaction. But they could be a store of value. There could be a market, and apparently there is a market for people who view them as digital gold and digital silver. I don't quite look at them that way, but I can see, it doesn't matter how I look at them, that there are people who do view digital assets as the potential store of value. Now, I mentioned gift cards. I want to show you something. It was unrelated, but it's very, very related. An astute person on Twitter, I don't know him, I don't follow him, his name is J.P. Koning, and he was remarking on the fact that Starbucks, this is pretty remarkable, has 1.6 billion in stored value card liability. So I guess people who frequent Starbucks, they get these gift cards, and I don't know why, they top them up and then they use them. Well, at any given time, if you buy a $10 or $20, $50, I don't know how much you can buy of these things, whatever you buy of them, there's a period of time where you're not using it because you stack them up so that you don't have to pull out your wallet each time for cash or your credit card. You just give them your card and you've got a certain amount of credits with Starbucks. People think that that's convenient. Now, you would think, why would you keep your cash at Starbucks? And it appears that what J.P. Koning is making a point is that Starbucks is making out on this, and that not that they're ripping off their customers, but that their customers are actually financing them, which is true. It says Starbucks cards, 6% of the firm's liabilities are comprised of coffee addicts paying 0% for the privilege of lending to their supplier. Yes, indeed, it is a loan. You're extending a loan to Starbucks when you buy a $100 Starbucks gift card. Well, at least Starbucks isn't charging you any interest. So I suggest that Starbucks gift cards are a better place to stash your cash than a negative yielding German bond, Dutch bond, Swiss bond, or any other negative yielding bond. Now, not all gift cards are created equal. The problem with a Starbucks card, as far as I can tell, is you can only use it to buy Starbucks. I suppose you can trade it for its cash value, but then someone who buys it has to want to use it at Starbucks. I think they're transferable. But you're buying overpriced coffee. And it does take some of the sting out of overpaying for coffee, given that they're not charging you a fee for the card. But you could do better in coffee by switching to Dunkin' Donuts or homebrew. So it's not really, I was being somewhat facetious that you're better off having a Starbucks card for $100 than having a negative yielding bond or a bank account that charges you interest. At least Starbucks doesn't charge you interest. But what they're doing is they're locking you into your choice that you must use your money that's locked into that card, even though it's 0% loan. You still have to buy overpriced coffee. But if you're going to buy it anyway, then it's not that big of a deal. Now you say, what about gift cards, like regular just cash cards from Visa? I think and MasterCard do them. They charge a fee, so they're useless. And I've bought them for people as gifts before. You buy a $50 card, costs you like $53, $54. It's really not $55. So you are paying for that. That's not really a good deal. However, there are some gift cards, like the Starbucks card. There could be a place, a restaurant, but I think the best one probably is, I mean, this is an investment advice or even advice in general, but the Amazon card charges no fee from what I recall. They sent me a promo offer once about a year ago, and not only did they say buy this card, they said we'll give you $10 extra if you buy it. I was like, okay. So I bought $50 or $100, whatever it was, and I got $10 extra. So there it actually paid me a rate of interest. And yes, I'm forced to buy goods. I was forced to spend it at Amazon, but I was probably going to spend it there anyway. So that's actually a good deal. So one could see where one might park $1,000 if you had $1,000 in Amazon rather than putting it in the bank. Because if it's at Amazon and you're going to spend it over the year or two, $1,000, you might as well leave it there. You're not going to pay a negative rate. You're not going to pay the $15 a month banking fee. So that might be maybe a boon for these retailers that have these cash cards. Now, in a sense, if this does catch on and people start to think this way, Amazon beats Facebook to the punch. They actually become not necessarily a bank, but they actually become like Starbucks in that they're going to have people lending them money they know they're going to get back at their rate, not of interest, but at their rate of profit or margin on the items they sell. So these negative interest, and remember the thing about negative interest rates is it forces people to spend and save their money. So you put it up front into Amazon, and you can see it's reasonable to do this. It's not crazy. Why put the money in the bank that you're going to spend at Amazon? Let's say over the course of a year or two, you spend $500 at Amazon. Why not give it to Amazon first, then putting it in your bank and having them take $75 out of that money? Doesn't make any sense. And if Amazon's going to give you a $10 credit for putting in $500 or a $50 credit, well, now you're actually getting interest in a sense from Amazon. And now if you're going to spend the money there anyway, and their prices are low, it's not like Starbucks where you're going to overpay for coffee, you might be better off. All right, well, that's my view. I want to know what you guys think, and we will see you tomorrow. If you've enjoyed this, I want to thank my patrons and subscribe star people who do donate a monthly amount. Very kind. Also to people who are sending me their thoughts to Smaulgld and sending checks and cash and silver, no gold yet, to Smaulgld LLC, P.O. Box 714, Dover, New Hampshire 03820. And also to those who have donated via Bitcoin and Litecoin. You can do that by holding up your Bitcoin or Litecoin wallet to the screen and hit the QR code, and you can send a donation to Smaulgld that way. Also, if you're interested, and PayPal also works, if you're interested in purchasing gold, silver, coffee, or other items, and Smaulgld mugs, the links are below this BitChute and this YouTube, and also on the Smaulgld.com site. Please remember to subscribe to Smaulgld.com, also to subscribe on BitChute. This BitChute will be on Smaulgld, it will be on YouTube for a limited time. Then, of course, I'm going to take it down. So if you want to keep up with Smaulgld right up to the minute, please subscribe to Smaulgld.com. You'll get a notification. You will get the most recent video with all the charts or whatever additional collateral I prepare for the BitChute. And then also, if you subscribe over at BitChute, you'll also be notified when a new BitChute comes out. The other reason to subscribe over at BitChute, I am going through the Smaulgld back catalog, and I'm not republishing the Smaulgld post, but I am including, if there's a video attached that I've taken off of YouTube, I'm loading it up on BitChute. So thank you very much.